I think I will slowly start to introduce this this webinar. So, good evening. I'm Cinzia Cidi. I'm Director of Research at CEPS, and I'm really very pleased to host this webinar, risk sharing in monetary unions. So the idea of this webinar actually came from Marco Butti from DG ECFIN. So I think I need to give credit also to DG ECFIN for, in the end, coming up with this with the preparation of this webinar on this topic, on which I had the chance to work a bit in the past, and so I'm glad that it's back in the debate. But above all, because we have an excellent lineup of speakers, and I'm really looking forward for the discussion. Before we start, let me briefly introduce them. So we will start with Luca Rossi. Luca is economist at the Bank of Italy. And the idea of this seminar actually came from a paper he wrote. So it was somehow a catalyst for the event. In his paper, Luca finds results which are quite different from some findings of the literature. So in a sense, this paper is quite thought-provoking, and it's a good start for the discussion. Then we will have Pier Federico Asdrubali, a senior economist at the European Commission. I'm pretty confident that most of the people in this virtual room know Pier Federico, at least his name, and probably have also read at least one of his papers. So his paper with Joshua and Sorensen is one of the seminal work and pillars for risk sharing. So I'm really glad, Pier Federico, to have you. Then Barry Eichengreen. Barry is professor of economics and political science at Berkeley University. Is an expert on economics, economic integration, functioning of financial markets, both in the United States and in Europe. So very, very pleased to have you. And last but not least, Daniel Gross. Daniel is former director of CEPS, now a member of the board and distinguished fellow. And I'm pretty confident that Daniel will lead the conversation on from the academic findings to the policy debate, mostly on the EU. With this introduction, I would like to give the floor to Luca for his presentation. Luca, the floor is yours.
Thank you, Cinzia. Thank you, everyone, for being here. Okay, let me share my screen.
So while Luca shares the screen, let me remind everyone that if you would like to ask questions, please do so by typing the question using the Q&A function, which is at the bottom of the screen, just in case we have been away for too long from Zoom meetings and we have forgotten how to use it. Luca, please.
Thank you again, Cinzia. Okay, so let me start. So today I'm going to talk about this paper I've been working on for a while now, which is about fiscal risk sharing in the US. Usual disclaimer applies, of course. So the debate about European integration, as you know, was already very alive before the pandemic. But then once COVID-19 hit, and in Europe we started to talk about the next generation EU, people started to again speak about fiscal integration in the European Union and the ways that this integration could be accomplished. Now, the merits of a potential fiscal union in Europe are based, as of now, by they're based on past research on US data, and a sort of consensus emerged whereby the US federal government, which is the federation that we Europeans tend to look at when thinking about fiscal integration in Europe, the US federal government does actually little to ensure states' income. So basically, the policy advice for Europe was push for deep capital markets integration and pretty much disregard fiscal integration. So in this paper, we do several things. So first, we focus on downside risk sharing. So this is the first paper that focuses on, I would say, the the part of the distribution that agents really want to hedge against, which is unexpected negative income shocks. We draw from a finance literature started by Markowitz in 1959, and we propose a simple method to compute downside risk in our application. So we provide the first estimate of downside of fiscal downside risk sharing for the US. And then in the second part of the paper, we sort of challenge some classic results from the literature, and in particular, we impose some assumption about some missing part of the data from the US, which is state level data for consumption of this capital. We impose some, I would say, reasonable assumption on that, and we are able to disentangle the capital depreciation channel of income voting for the US. What we find, so first, we find that the federal system of taxes and transfers is able to hedge more than was previously estimated. In particular, we find around 30% income growth risk sharing in terms of the fiscal channel. Previous papers estimated around 10-15%. Also, contrary to previous paper, we find clear evidence for increased fiscal risk sharing, and this is sort of, I would say, consistent with the fact that the importance of the federal government in the US in terms of direct payment to individuals or grants to states have gone increasing quite a lot in the past few years. And as I said, once we take into account the capital depreciation effect in the US, we actually find that what was previously thought to be a capability of the capital market channel of risk sharing is actually driven by capital depreciation. And if we have time later, I will talk about that in more detail. I think I have to skip quite a lot of technical details, so let me just focus on the important things. So our baseline methodology draws from this paper by Athanasoulis and Van Winkop in 2001. So this is I think the only paper in the risk-sharing literature that explicitly focus on an ex-ante concept of risk. So basically, what the authors say, they say, look, we can. So let's take idiosyncratic growth for each state in the US. So this GI minus GUS is idiosyncratic growth. Sorry, I think there is some background noise. I don't know if you hear that. I don't know. Maybe someone can shut the mic, please. Thank you. So we have this idiosyncratic growth here, which is idiosyncratic growth for every US state. As you can see, these are basic forecasting regression. Okay, so we basically control for a bunch of variables that could predict growth rates, and we are left with this residual component here, which whose standard deviation, this sigma h here, can be thought of as a measure of diversifiable risk. Okay, so and if you think about what the authors say, they say, look, okay, this sigma h here is a measure. We can see it as a measure of a growth uncertainty. Okay, and if you think about sort of 15 years earlier than the modern uncertainty literature, those economists sort of said, okay, the way we define uncertainty is the unpredictable component of the dependent variable we're interested in. And that's exactly, if you think about what Jurado and co-authors do in their 2015 paper, measuring uncertainty. That's exactly, I mean, that's the same thing, simply it's a different, I would say, methodology. Here we don't have factor models, but the setup is the same. So once we control for predictable variation, we are left with there's a residual component here, and the volatility of this component is our definition of risk. Okay, so in a way, these are so this is consistent with the modern definition of uncertainty. So what they say, what they do then is they say, okay, let's take a definition of income where we strip out all the federal government intervention, okay, in the US. So basically, let's not take into account federal taxes, government contributions for social government, contributions for social security, and federal transfers. So let's take one definition of income that is defined in this way, and then let's take another definition of income, which is income after federal taxes and federal transfers are taken into account. Okay. So once we compare, once we run regressions for those two definitions of income, and we single out a definition, an estimate of risk, we can compute risk sharing basically as the percent reduction in this standard deviation. Okay, so very, very simple approach, but I would say very, very intuitive. So we borrow from them, and we actually, so I don't have time now to go through the details, but what we do is we sort of, on the one hand, modify their setting to account for some, I would say, yeah, technical detail, and then we apply our definition of downside risk, and then the way we compute downside risk sharing is pretty much the same as is done in this paper, but using this semi standard deviation, which captures downside risk. Okay. Now, actually, one of the things that drives a lot of our results, I would say, is not much the methodology, but it's more the data set. So what we do is we focus on labor income. So this is something that was already done in this paper by Duike and Farvak in 2018. So as opposed to previous research, we don't use personal plus corporate plus government income, but we focus only on labor income. The reason why we do that is that we are interested in the average US citizen, okay? And as we all know by now, capital income is extremely concentrated, okay? So here, just for this slide, so here we see that pretty much 99% of US households derive the great majority of their income from labor. So if we are to focus on, I would say, a representative agent, disregarding capital income reduces a lot the aggregation bias that we have once we implicitly aggregate all the households in a given state. Okay, so that's pretty much the reason why we decide to focus on labor income alone. And incidentally, people that earn labor income are those that get also quite a lot of transfers from the federal government. Of course, that's the case. So let me jump to the results. So what we find, so our baseline estimates are that fiscal risk sharing starts out, I would say, with an estimate that is very similar to previous ones, so close to 10%, but then jumps up right in horizon 2 at values around 30% and stays there for the remaining horizons that we are interested in, which are pretty much business cycle frequencies. So this is the I would say the main result of the paper, and so yeah, so as opposed to previous research which found a very small fiscal risk sharing capability from the US, we see that if we concentrate only on the US, if we concentrate only on labor income, we do find that people earning labor income actually are insured and quite a lot by the federal government. And so here, I don't have time to go through all the panels, just look at the top left one. So the blue line is what we have if we use a definition of income that is very close to what Pier Federico did in his paper in 1996, the QJ. Whereas the brown one is what we get when we use labor income. So you can see that the pretty much great part of our results is driven by the data set. Okay, let me now go quick on that. So this was the first part of my results. So in the second part of the paper, what I do is I try to overcome a sort of limitation that is inherent in state level US data. So previous research basically did not take into account when studying the US, the effect of capital depreciation. So the risk-sharing effect of capital depreciation. And the reason was simply that no state-level data for capital depreciation exists in the US. You can find that, of course, if you look at the European Monetary Union, but no state-level data exists for consumption of fixed capital. So given the way that many data sets are built in the risk-sharing literature when studying the US, the effect of capital depreciation was implicitly added to the capital market channel estimates. Again, I don't have time to go through the reason why is that, but I mean that's what happened that's what you see in much of past research. So actually, what I do here is I say, okay, let's try to single out state-level estimates of capital depreciation. So what I did is, okay, we know that state-level estimates of gross operating surplus do exist, and that capital depreciation is simply the difference between gross operating surplus and net operating surplus up to the statistical discrepancy, which is very small. So if we find reasonable state-level estimates of net operating surplus, we can actually then back out capital depreciation at the state level for the US. So what I did is I looked at the 6 components that add up to net operating surplus, and I tried to find some allocation weight. Okay, so some state level weight that could allocate the aggregate subcomponents to every state. So let me go through that. So so the first component is proprietor's income with inventory valuation adjustment and capital consumption allowance, which is not available at the state level. What we do have available at the state level is simply proprietor's incomes without those adjustments. And when you look at the difference between those 2 measures in the aggregate, I mean, to all practical purposes, the difference is pretty much 0. And that's true for these and as well for rental income of persons, which together account for around, I mean, almost 50% of net operating surplus. So almost half the variation of net operating surplus is allocated in a very, I would say, reasonable way. Then we have business car and transfer payments and current surplus of government enterprises. Those are very residual component of net operating surplus, as you can see here. They account 3 and pretty much 0% of net operating surplus. I just allocate them with GDP. I'm pretty sure nothing would have changed if I just didn't have considered them or allocated them in some other ways. Then we have corporate profits. So what we do here is we allocate them with personal consumption expenditure. So these are weights that I mean I found not to be not that different from what done by Pier Federico when he allocated corporate income tax rates. So if I recall correctly, Pier Federico, you used, I guess, average of property income and personal income, I guess. And they found that weights were not that different with personal consumption expenditure, which is a data that became available starting in 1997. So that's the reason why I use that. And finally, we have net interest and miscellaneous payments, which didn't have probably an obvious candidate to be allocated at the state level. So what I found is monetary interest receipts, which are understandably quite correlated with net interest. Those are a pretty good candidate. Indeed, the correlation in level between those 2 variables in the aggregate is 93%, and the correlation in growth rates, incidentally, is also 93%. Plus, the order of magnitude of those 2 measures is pretty similar. So I think monetary interest receipts are sort of 60% of net interest, something like that. So I allocate them in this way. So what I find, once I then find state level estimates of capital depreciation, which then is just the difference between gross operating surplus and net operating surplus, what I find that, what I find then is that what was previously thought to be an income smoothing capability of the capital market channel, which is what you see in this column 2 here. So this 41%, which is estimated to be in standard models. Sorry, I forgot to say, so this is the framework developed by Pier Federico and co-authors. So if you don't account for capital depreciation, you find a very high estimate of the capital market channel. But once you account for that, once you account for capital depreciation, you actually see that pretty much all this effect is driven by capital depreciation. So the capability of the capital market channel sort of disappears. So this is something that was in a way found not for the US, but for the European Monetary Union in a paper by Sorensen and Yoshi in 1998, if I recall correctly. So here we basically find the same results. So what is different is this big effect of capital depreciation, which is not found by other papers. Cinzia and co-authors also have some estimate for the European Monetary Union, where they account for capital depreciation. They don't find this large effect. So that's something probably we should investigate more about looking forward. So this is it. So basically, to recap, so in the paper this paper provides the first estimates of downside risk sharing. So our methodology is suitable not just for fiscal risk sharing, but also for any other risk sharing channel you're interested in. So what we find again is we sort of revisit the case for the existence of a fiscal union, or probably better of a federal government, by showing that its beneficial effects in terms of risk sharing are higher than previously calculated. Of course, risk sharing is just a part of what a federal government brings about. Of course, there are issues also of redistribution and incentives. So as of now, so this paper does not account for that. So that's of course a very important piece of the analysis. And again, future. I mean, I'm sort of working on that as a follow-up, I would say, of this paper. I still don't have results, but I hope to be able to have something soon. So we find that the fiscal union in the US accomplishes more than previously estimated, and that the capital market channel, at least as it is estimated by I would say traditional methodologies, so the one developed by Pier Federico, this channel is estimated. The reason why it was estimated to be this high is actually due to the fact that the capital depreciation channel was included in the analysis implicitly as of now. So I think one of the things that are not considered when talking about the benefits of further fiscal integration in Europe is what today in the uncertainty literature is pretty much taken for granted, which is reduction in second moments have strong first moment improvements. Okay, so when you reduce uncertainty in a system, first moment effects, so growth rates, let me put it this way, can get a boost. So that's, I think, probably a piece of information that has been sort of neglected in the debate. And so we have a sort of a trade-off when considering further steps towards fiscal integration in Europe. So on the one hand, you surely have redistribution, and I think it would be very hard to design a system, a federal government in the European Union that doesn't have redistribution. Probably it's just impossible. But on the other hand, you also have the benefit of risk sharing, which is reduced uncertainty for everyone, and that can have that has first moment effects that are probably worth considering when thinking about when talking about fiscal integration in Europe. And then last thing, in this paper, I'm not saying the capital market channel is useless. All I'm saying is probably we would need different empirical approaches and different data in order to correctly evaluate the strength of this channel of risk sharing. I mean, again, we leave for this for future research. So those are pretty much my results, and any comments is welcome. Thank you. I hope I don't know how, if I have still some time, but I guess I'm pretty much done, right?
I suggest we close for the moment, and then Luca, you will have the possibility to react. Many thanks for this presentation. I know it's pretty difficult actually to present a very long and complex paper in few minutes. I will now hand over directly to Pier Federico to share his comments with us. We can see the presentation. I guess you can go in full screen.
Okay. Can you hear me now?
Yes.
Okay. Thank you for this presentation. Thank you for inviting me. I think a useful way to look at Luca's paper is by interpreting it as a series of contributions to an underlying framework, more general framework. In particular, the context that I would start with is the context of consumption theory. Consumption theory includes two important tenets, among others. One very famous, the idea of the permanent income hypothesis, under which, under complete markets, you obtain intertemporal consumption smoothing. This is a typical test of this proposition, of actually an implication of this proposition, the implication being that predictable income changes do not affect consumption changes. Notice that this type of test includes a term that is linked to an ancillary equation that has to describe the income process. In other words, in order to decide how to change my consumption, I need to know the income process. If the shock that I'm predicting is permanent or transitory, if it has the higher the persistence, the higher will be the change in consumption that is warranted. An apparently symmetric proposition is the resharing proposition, according to which, under complete markets, you obtain intratemporal consumption smoothing. In other words, your consumption changes are independent of your idiosyncratic output changes. And this is a typical test that you find in equation 2. Notice that here you don't need to know the income process. Under complete markets, if you are fully insured, you don't really care whether your idiosyncratic income is predictable or not. You're just insured, you know that you will share a fraction of aggregate income or consumption. This is the setup to which Luca refers. This is a blow-up of equation number 2. This is the system in Asdrubal, Sorensen, and Yosha's paper, where we try to characterize the failure of the risk-sharing proposition. How do we do that? Each equation is supposed to capture one risk-sharing channel: capital market, fiscal transfers, credit market, and finally the unsmoothed part. Just to give an example how this works, if the rate of growth of gross state product increases by 1%, you're on the right hand side, the first term on the left hand side will also increase by 1%. Now, if there is full risk sharing, this term will not, the rate of growth of state income will not increase. We have provided complete smoothing to the volatility of GSP growth. In this case, you have 1, so the beta k will be equal to 1. If on the other hand, facing an increase of 1% in the rate of growth of GSP, and here increases by 1%, and SI also increases by 1%, there is no risk sharing. This difference is zero. It means that any difference between GSP and SI, typically net income flows from other states, will have played no role in reducing the volatility of the rate of growth of GSP. The same logic applies to fiscal risk sharing here, to credit market risk sharing here, and here is the part unsmoothed. This setup, as I said, tries to investigate whether there are multiple decentralization mechanisms at work instead of only portfolio diversification as typically assumed by the standard risk sharing proposition. It explores whether there are complex dynamics and so on. So Luca's contributions refer to this setup. Let's start with the idea about capital depreciation. What he argues, the capital depreciation refers to the first equation here. What Luca argues is that the difference on the left-hand side includes depreciation, and the depreciation provides the bulk of risk sharing. The strength of this approach is that there is a meticulous and ingenious effort to gauge state capital depreciation, but I find some weaknesses in the methodology. First of all, the role of depreciation, unlike Luca's findings, in most risk-sharing studies is small and typically negative, both intrastate and interstate, or intra-national and international risk-sharing. But we can go further than that. We can check the US aggregate relation between GDP and capital depreciation by running a time series of the first equation. Granted, this is not the real thing, because you should have a cross-section of all the states. But it's instructive that this time series yields, which only includes depreciation, yields a negative risk sharing, meaning that the presence of depreciation increases the volatility of GDP growth, that is, provides this smoothing. How can you check that? Well, if you manipulate the left-hand side algebraically, you will see that it is essentially approximated by the ratio of depreciation over GDP, of the change of depreciation over GDP. In other words, if this ratio is counter-cyclical, then you would indeed have a negative risk sharing, a negative smoothing. And indeed, as Luca himself shows, the ratio of capital depreciation over GDP is counter-cyclical. That's why you get this result. Now, to conclude on this point, I think it's statistically unlikely that you have a negative role, a desmoothing of capital depreciation in the aggregate, and you instead have a high level of smoothing in the cross-section of the states. The other points on Luca's paper refer to the risk definition. He argues that idiosyncratic risk should be measured by the unpredictable component of the idiosyncratic GSP growth, the so-called residual risk. Again, this is a very interesting alternative definition of risk drawn from Atanasoulis and Van Winkop that focuses on ex-ante risk, that is, as he said, on the predictable, on a predicted equation. However, the point is that if you focus on only one component of the idiosyncratic growth rate of GSP, you are inconsistent with risk-sharing theory, because risk-sharing theory only talks about idiosyncratic, as without distinguishing between the predictable and the unpredictable part. Why? Because of the reason I mentioned at the beginning. If you're fully insured, you don't care whether your income process delivers a permanent or transitory, a predictable or an unpredictable GSP growth income process. Okay, we can discuss about this later, but there is a reason. There is a second argument that if idiosyncratic GSP can be approximated by a random walk with drift, as it's typical of income measures across the world, then what this means is that the GSP growth is mostly unpredictable. This means that the share of variance, the fraction of variance explained by the predictable part in Athanasoulis and Van Winkop's and in Luca's paper should be small. And indeed, in Athanasoulis and Van Winkop's paper, the result of the capital market and fiscal resharing, which are the only ones that they provide, are pretty much similar to Asdrubal, Sorensen, and Yosha. Indeed, in a way, I did the same. I tried to do a similar exercise in my paper with So-Yan Kim in JME in 2004. There, I ran VAR, and the first equation of the ER, the equation that extracts the GDP, the GSP shock, is essentially a predicting equation, because the right-hand side is the GSP and the contemporary GSP, and the right-hand side is composed of all the lagged variables. So it's a form of a predicting equation. And sure enough, also that equation yields very similar results to Asdrubal, Sorensen, and Yosha. The other points that Lucas makes are all really interesting. The downside risk part and the labor income part. He suggests to focus only on certain components of GSP growth. But as I said, that is not consistent with the theory of resharing. If you want to focus on one specific component, either I think you develop your own model of resharing where only that component matters, or otherwise, my suggestion is to interpret this as a decomposition. This you may want to decompose income into labor income and non-labor income, and show the resharing, the smoothing effects of each. I think it would be equally interesting, but the result would be placed in an internally consistent framework. Okay. The other thing is that if you only limit yourself to one aspect of GSP or of output, then you cannot cascade your equations into consumption, because you would have to calculate consumption out of labor income in order for this to become a theory of consumption, or to test a theory of consumption. As for the resharing metric, I don't have much to say. I think it's an interesting alternative. The only critique that I may have is that it's not unit free, because it's the ratio of standard deviations. Whereas, if you remember, in the case of the Asdrubal, Sorensen, and Yosha system, the betas can be interpreted as elasticities. So they're in terms of a pure unit that does not depend on the unit of measure. Anyway, this does not make much of a difference if you use this measure with different income measures, metric with different income measures, because they all have the same units, more or less. Okay, he didn't really talk about his methodology of using population-weighted observation, but I think this is one of the most intriguing parts because it's an interesting alternative estimator to the differentiated states. That is, he places more importance to states with larger population. This might be policy relevant, but I think this is a philosophical issue somehow. It depends on the spirit, on what spirit you carry out your estimation. In my case, I wanted to test a theory. I wanted to test the risk-sharing proposition. For that purpose, whether the failure of the risk-sharing takes place in Rhode Island or takes place in Texas, to me, that's the same. But I do recognize that for policy purposes, you may want to be placing more attention to what happens in Texas, which is much more populated than Rhode Island. So as a final considerations, I think that the reversal of importance of capital market integration with respect to fiscal integration is not, at least yet, fully warranted. Also, given the role of credit markets, I did not talk about that, but the role of credit markets is essentially the role of capital or financial markets, because credit markets are the stock that corresponds to the income flows of the capital market channel. So I think it's hard to exaggerate the importance of capital market risk sharing, at least in the estimation within the United States. So my final suggestion to Luca would be to connect the points, in the sense that instead of having a paper with separate contributions that are essentially empirical, although they might have a very interesting policy implications, I would suggest to place them in a structured model, because he has enough material to come up with the model of his own, or either theoretical or empirical. And that would be, I think, would give worth to all his very interesting results. Thank you very much.
Many thanks, Pier Federico, for all your very detailed comments and also the suggestion to Luca. I propose we move directly to Barry Eichengreen to hear his views.
Thank you. Here in California, we certainly believe in placing a heavier weight on larger states. And thank you to CEPS for the opportunity to provide a few comments. I was interested to hear that Marco Butti was one of those who suggested we do this. So it would be great if the Commission began to push some of these related ideas. So Luca has rekindled a set of debates asking whether to achieve effective risk sharing. Does the EU need to build out fiscal federalism a la the United States, or can it simply rely on capital markets for diversification away from idiosyncratic national shocks? Is capital markets union enough for effective risk sharing? In other words, as I've said, I think and hope that discussions of fiscal federalism in Europe are again timely, and related to that, something that hasn't come up yet, but on which US experience can indeed shed light, is the question of how the EU's fiscal rules might have to be revised to enable effective risk sharing across member states. So I appreciated the opportunity to think again about these issues. It's been a long time, actually, since I've thought and written about them in the 1990s. So I'm grateful to Luca and to Pier Federico for reminding me of how the literature has moved on since I started to think and write about fiscal federalism in Europe. Rossi makes multiple contributions in his paper, as some of which we've heard, and there are still others that time didn't permit us to discuss. So there's a comprehensive survey of the literature starting in the 1990s and coming up to the present day. There's a taxonomy of results and an explanation for why different papers reach different conclusions about risk sharing, showing, for example, that studies focusing on the behavior of personal income typically find larger effects of federal taxes and transfers in offsetting income risk than do studies focusing on the behavior of GDP. And there's some intuition for why those differences exist. Luca develops a new measure focusing on labor income and distinguishing declines in labor income from increases in labor income on the grounds that we should care more about the former than the latter when thinking about risk sharing. And in focusing on labor income and developing this new measure, he effectively rehabilitates some older results, finding that fiscal federalism is more important than risk sharing through capital markets, and suggesting by implication, in my view, that capital markets union by itself will not be enough. I think since we're talking about the experience of US states, I think US experience with risk sharing during COVID-19 is consistent with this emphasis. There were, in fact, large transfers from the federal government to the states, consistent with the federal government's superior ability to borrow during the crisis, owing to balanced budget rules at the state level, in many cases, owing to the mobility of state tax bases, which limit the ability of individual states to mobilize additional resources by raising taxes unilaterally. Those federal transfers targeted households that relied on labor income, although I would argue that those transfers could have been targeted better, especially in December 2020 and March of 2021, when some of the transfers were targeted at households with household incomes of up to $150,000 a year. That doesn't strike me as efficient targeting of labor income. And there has been some subsequent scholarship, as in this NBER working paper, finding that the state aid formula in the American Recovery Plan directed dollars primarily towards states where there were large increases in Medicaid enrollment, Medicaid expected outlays, and child health plan CHIP outlays, as well as Luca notes in his paper. Medicaid grants are the most important federal grant to the states, directed specifically at the household sector. So you can look at 2021 and you can see fiscal federalism in the United States at work. Let me ask some policy-related questions about the paper, and Pier Federico anticipated a number of these, although framing them in a different way. Why labor income rather than consumption? Isn't consumption, the household's ability to put food on the table, what we really care about? So this issue pops up briefly late on page 27 of the paper, but it is not the focus, and I would argue it should be. We do know consumer spending by state, courtesy of the Bureau of Economic Analysis. So we didn't back when I did my early work on fiscal federalism and risk sharing. Now we do. So I think that should be taken better advantage of. Do we really care only about the unpredictable, unforecastable component of labor income fluctuations? That point has already been raised. I don't think the typical household engages in optimal intertemporal consumption smoothing. And insofar as it doesn't, maybe we should also care about the predictable, the forecastable component. Is the United States an appropriate benchmark for thinking about risk sharing in Europe? We have a rather different distribution of labor income across households in the United States than you do in many European countries. So do results in the US apply to Europe? Certainly, I think findings for the US ought not be mechanically applied to Europe. And why continue looking at aggregate macro state level data 25 and more years after the genesis of this literature when we have rich household level micro data sets on consumption, on transfer receipts from different levels of government, et cetera, for the United States. So microdata on labor income and consumption by individual households could be linked up to their state's payment of taxes to Washington, D.C., receipt of transfer payments from Washington, D.C., state level rules about Obamacare and unemployment compensation and so forth. And I think one could derive a richer set of conclusions from that. Finally, the problem with EU fiscal rules. So Tam Bayumi and I focused on this way back again in the 1990s. US states, as well as the US federal government, do some macroeconomic stabilization because they have rainy day funds that they can run down in bad times, because the stringency of their fiscal rules limits on their ability to borrow vary depending on state. But what we found was how much stabilization individual US states can do depends on the intensity, on the restrictiveness of those fiscal rules. And in particular, we found that moving from the least restrictive fiscal regime to the most restrictive fiscal regime lowered the extent of the offset to state level income fluctuations by about half. So to my mind, that raises the question of whether the EU has moved far enough in the direction of introducing countercyclical fiscal flexibility into its rules to empower individual member states to supplement what an EU budget might do, to supplement what capital markets union might do. So I read the paper as yielding the following conclusions and implications. Capital markets union may not be enough. Discussions of fiscal federalism should continue. So too should discussions of possible revisions of EU fiscal rules, given how these can limit the ability of states to self-insure. And in addition, there's reason to worry that EU member states may look more like US states, with the latter's limited ability to borrow, given that individual EU member states are coming out of the COVID crisis much more heavily indebted. So thank you. Let me stop there.
Many thanks, Barry, for your comments on the paper, but also for extending the reasoning and the thinking also to more policy-related issues. And I think this makes a nice transition to Daniel.
Thanks a lot, Cinzia, and thanks a lot to Luca for this, I think, very interesting paper, which has led me to revise some of my priors. And I very much like the concentration on labor income, which is, after all, the mainstay of, as he showed, 90% of the population. I also liked something which has not been discussed a lot here, is the emphasis on downside risks. Because we always treat these shocks symmetrically, but both for states and for individuals, very often the downside risks are the ones that really hurt most. And especially, that's another point which Luca couldn't show, the emphasis on large shocks. Because the cost of these shocks, when they are large, might be more than proportional. And I think you had a slide in your paper where you jumped over, where you showed that the insurance is larger for very large negative shocks. And I think that is really also the problem in Europe, where when a country is affected by a very large negative shock, then on top of just the loss of GDP, the government might also find it difficult to have market access, and the enterprises in that country and the banking system in that country might come under stress. Therefore, all these transfer mechanisms, I think, even if a country receives billions and billions, it doesn't matter a lot if your entire financial system becomes dysfunctional. So that means that I would actually say that in Europe, the capital markets union remains important, not so much that it provides capital income, which smooths out national shocks, but insofar as it can isolate the domestic financial and financial system and corporates from experiencing financial difficulties when the government does so. So the idea would be, if you had a Euro area or EU-wide capital market with lots of equity financing, that would make corporate sector less dependent on the risk premium they might face otherwise. If the banks were more supranational, the same thing. And therefore, I would say the capital market union remains very important, but perhaps for a different issue than the ones that you get in this literature to which you contributed, Luca. Now, what can we conclude when we look at, as I would do, mainly at the problem of large shocks, large negative shocks? Now, we all know that in this particular crisis, we in Europe have innovated. We now have the SURE system, which provides a reinsurance of national unemployment insurance systems. This is probably something which would not show up in your equations or in any of these equations, but it is still, in my view, a very large, very potentially important shock absorber. The NGU system, actually, again, I would ask how it would show up in your or other people's equations, because it was a very important instrument, perhaps not so much because it directly changed the income of people, but because of what it prevented, namely a financial crisis and a financing crisis for governments. And I mentioned just as a parenthesis something which we discussed among us before we started, which is that in theory the EU has, or the Euro area rather, has already this budgetary instruments for convergence and competitiveness, so-called BIC, under which money could be made available to Euro area countries to smooth shocks. It's interesting that this instrument has been completely forgotten in the COVID crisis last year, and something was done at the EU level. And maybe that's something we should reflect upon. Is the shock absorbing, which we are discussing, or say necessary for a monetary union, meaning the Euro area, or is it something which exposed turned out whatever, necessary and politically feasible in a, how shall I call it, very impartial political union, which the EU is. And my reading of the revealed preference of policymakers is that it seems to be more related to the EU as a political union than to, or the need for have some shock absorber is related much more to the political union aspect, if you want, of the EU than the monetary union aspects of the EA, of the euro area. And then finally to the question, which also Barry raised to some extent, do we need more than what we have now? And the question here is, I take it as to say, do we need any further formal mechanisms? Because what we have shown is that in an emergency, if there's a very large shock, you can create a shock absorber ad hoc. And you already have one example. And that, in my view, is already stabilizing, because it will tell markets that should another big shock come along, something similar might come about. And if I'm not wrong, this is similar to the United States, where the federal level decides always, in a certain sense, ad hoc, to grant these extended unemployment benefits, which are part of the shock absorbing in the United States. This is not something which is formally originally codified, but politically it just happens with regularity. So I will therefore conclude by saying that I have learned something methodologically and technically about the importance and the difference between labor income and overall income smoothing. But I would very much emphasize the part of the results which insist on large negative shocks, which is, I think, the key issue for Europe, which is always an issue which is linked together with the state of financial markets. And that's why Europe, in a certain sense, is special and different from the United States.
Thanks very much, Daniel. So we are already over time. But I would like to give the opportunity to Luca to react maybe just to a couple of questions. And I would like to add one which has been put in the Q&A, which is if you can give an economic intuition of how capital depreciation actually can work as consumption smoothing mechanism. So maybe a couple of minutes to take a couple of questions plus this one. Luca, you're muted.
Yeah, so can you hear me now? Yeah, so thank you, Cinzia. Thank you, Pier Federico, Barry, and Daniel for great discussion. So let me go through some of those points. So starting, I will go in order, more or less. So I think here, like, what I have in mind is probably a sort of different paradigm altogether. So when I run those regressions, I probably don't have much in mind consumption theory, but more, I would say, real options theory. Okay, so and so the fact that a simple reduction in uncertainty. So let's say you have an investment project which has some uncertainty attached to it. If you manage to reduce that uncertainty, the likelihood that you will spend the money to actually make the investment, and for an household can be buying a car, let's say, or spending more on, I don't know, whatever discretionary consumption good you have in mind. So reducing that uncertainty is something that is beneficial already. So that's pretty much what I have in mind, and what I had in mind when I decided to use this framework from Atanasoulis and Van Winkle. So it's probably a very, I would say, different setting. So maybe more even a risk management setting. So risk reduction is useful per se, and also so this is probably a point that was raised by Barry. So why not use also, why don't look also at the predictable component if I got it right? So the thing is, if you are, let's say, Mississippi, and you consistently have a lower growth rate as opposed to the U.S. average, that's not a shock. That's something that is predictable. And if you get federal money out of that, that's not risk sharing, that's redistribution. Okay, that's what I think, and that's indeed what I'll probably start to work on. So when I said I was working about when I was working also on redistribution, that's exactly the point. So any let's say any systematic let's say lower growth a given state might have, once it becomes systematic, so it's not just a one-time event, that enters into the conditional mean, so that's predictable, and any money you get out of that, it's I think it should be labeled redistribution, not risk sharing. So that's why we just don't look at the predictable component. So going back to Pier Federico and talking about capital depreciation. So it's true that the capital depreciation output ratio is counter-cyclical, but the reason is that the reason this ratio is counter-cyclical is because when GDP when you have GDP going down, capital depreciation falls by less than GDP does, and that leads to this ratio becoming counter-cyclical. But the thing is, capital depreciation co-moves with GDP, and since capital depreciation is a cost to companies, and this answers the question that has been raised by the audience, since capital depreciation is a cost to companies, whenever, if you are in a crisis, your cost goes down, that's a risk-sharing mechanism. It's not an interstate risk-sharing mechanism, it's a within state, but still it's a risk-sharing mechanism. So you go into you enter into an idiosyncratic crisis, you use less your machinery, so that turns out with a lower rate, and you save on capital replacement. So that's pretty much the mechanism. So again, yeah, why? So labor income is not consistent with consumption theory. Okay, so that's probably true. I mean, that's surely true, but again, reasoning in very intuitive terms and probably backed by, yeah, again, I would say real options theory. If I know that let's say in this case, the federal government will step in if my job gets lost, that's a risk reduction already. So I know that if I lose my job, I will get some backup from the federal government, and that already today is something that will help me in deciding. I mean, probably there will be some point where, thanks to this implicit insurance, which will become explicit if I really end up losing my job. If I know this, I will spend more, and companies will spend more as well. So risk reduction per se is something that, irrespective of, let's say, my utility function or whether we have complete markets, is something that is beneficial per se. I would say, I mean, that's my view about that. Okay, so credit markets, they are important. Yeah, I mean, yeah. So I agree. I mean, I'm not trying to say that public risk sharing is the only mechanism that works, and I'm not ideologically against the capital market channel. This is just what I find. So indeed, and this is going maybe to Daniel. I also agree that capital markets union, which I think now after Brexit and COVID, we'll go back talking about that in the European Union. So I do think that it will be a very important goal. So I do believe that. So, and again, so this paper is about risk sharing, and as I said, risk sharing is just one piece of all these. So when we talk about fiscal, a federal government, we have risk sharing and we have redistribution. So here, all I'm saying, for instance, is this: that we do have a sort of trade-off between redistribution and risk sharing. So my little contribution is saying maybe we were thinking that the federal government doesn't accomplish anything in terms of risk sharing, and so if you are just left with redistribution, then probably I mean, we sort of can understand that no one probably wants the European Monetary Union to become a transfer union, but if you take into account the fact that risk sharing is important, then we do have a trade-off, okay? Or at least the balance against the European federal government is sort of, I mean, the equilibrium sort of changes towards thinking about that maybe the fact that maybe European federal government could be beneficial in Europe. So going to Barry, so yeah, you said, yeah, why using again aggregate data and not household level data? That's a good point, and indeed that's something I would like to work on in the future. So yeah, for the US at least we do have household level data, and yeah, so that's something I would like to work on. I mean, they're just sort of not that immediate to work on. So state level data is very easy to use. Household level data, I mean, is just not the same sport, I would say, but yeah, definitely that's something we should work on. And I guess, as far as I know, no one did household level risk sharing. I mean, I could be wrong, but I guess that's it. So I think, yeah. So just maybe to conclude. So going to Daniel. So do we need more in terms of fiscal integration? I think that's still an open question. So again, this paper sort of rebalance, as I said, the equilibrium towards the fact that maybe a fiscal union could be important. Also, when we talk about fiscal union, I think maybe it's sort of misleading. I guess we should better talk about the federal government, because fiscal union. So in Italy we have a fiscal union, but we don't have a federal government. Let's say in Italy we have a very high degree of centralization. So a proper federal government should sort of balance the sub-national levels with the federal one. And that's something we don't have neither in Italy neither in Italy nor in the European Union, for completely different reasons, of course. And when we think about that, we should, of course, think about giving the right incentives. So that's I'm completely sympathetic about. You just can't set up a federal government with, let's say, crazy vertical imbalances between different levels of governments, because that doesn't give the right incentive to behave correctly. That's something we know well in Italy. So yeah, I think once we go to the policy debate, of course, things get much more complicated. So how do you set up a proper federal government in Europe? That's a much more, I would say, difficult question to answer, but probably it's worth it to go back, think about that. So thank you, and I'm happy to receive further questions if there are more. Thanks.
Many thanks, Luca, for this comprehensive reaction. I think we need to close. I mean, two of the speakers had to leave. We are almost 15 minutes over time. So many thanks. Maybe just one last comment. I mean, after living almost 15 years in Belgium, which is a federal state, I'm not sure it's so easy, actually. The federal solution, it's so easy.
Cinzia.
Yeah. Federico, I think he has maybe a weak connection. In any case, I'm afraid I have to close it here, and I guess Luca and Pier Federico will have the opportunity to continue this conversation. Many thanks to all those who stayed, and I'm pretty sure we will discuss again risk sharing and its policy implications. Many thanks, and have a good evening. Thank you.